Welcome back to Investing Talk Podcast. Today, we're diving into the really dynamic world of Chinese smart electric vehicles. And the big question on many investors' minds, institutional and retail alike, is about Xpeng. Is now a good time to buy the stock?
It's definitely the question of the hour. Because, the whole story around Xpeng has just flipped, hasn't it? Over the past 6 months or so, we've seen it go from a company kind of struggling, facing margin pressures, maybe slow execution,
Yeah.
to now it's showing some serious operational muscle, really scaling up.
Absolutely. And just so everyone knows, our analysis today, it's grounded in quite a bit of material, recent financials, stacks of analyst notes, market momentum data. It's all current as of early October 2025. We want to get past the headlines, really understand the health and the potential future for what is, let's face it, a pretty volatile stock. And hey, if you find this analysis useful, please do subscribe, like the video, leave a comment. Also, very important, if there's a specific company you'd like us to look into like this, just drop it in the comments below.
Okay, let's start with that recent history, because momentum, particularly in the EV sector, seems to be absolutely critical. For over a year, Xpeng conversations often had this skeptical tone, didn't they? But the last 3 months, wow, a major shift in market sentiment. What actually drove that change?
In a word, deliveries. Just pure impressive delivery volume. They basically proved they could build and get cars out the door at scale. Look at Q3 2025, Xpeng delivered 116,007 vehicles.
That sounds like a massive number, but maybe put it in context for us. Right, so that's a 149% increase compared to the same quarter last year, 149. It is by far their strongest quarter ever recorded. But what really got the market buzzing, I think, was the consistency month to month. September alone, 41,581 vehicles. That confirmed the ramp-up wasn't just a blip up 95% year over year for the month. This looks like sustained high-gear execution.
Okay, I get that volume is important, but often, especially in the EV space, you hear about companies pushing huge volumes, but maybe selling at a loss just to grab market share. So why did the market react so positively to these specific delivery numbers? What made the stock jump like it did?
Because it wasn't just volume, it signaled efficiency. When a company can ramp up deliveries that fast, it suggests their fixed costs. The factories, the R&D hubs, the assembly lines are being spread over way more cars. They even highlighted how quickly the 10,000th new P7 model rolled off the line. That points to manufacturing smoothing out. That's the operational story investors were waiting for. The machine is finally hitting its stride. And that's what you need before you can really talk about profitability.
And that operational success, it translated pretty directly into, well, cold, hard investor confidence. We saw the stock price bounce back significantly, pushing towards that 21.1 level from much lower points. Was this just retail excitement, or were the big players involved?
Oh, the institutions definitely got involved. That rebound wasn't just froth. It had solid institutional backing. We saw buy ratings coming in from big names, Citigroup, BofA Securities, Macquarie. And importantly, these weren't just, lukewarm holds. The price targets they issued suggested some pretty significant upside. We're talking 18–19% on the low end, up to almost 40% potential upside.
Analyst targets are one thing, definitely part of the picture, but how often do we actually see management, put their own skin in the game? Was there a concrete sign of that internal belief?
Yes, and that's maybe one of the clearest signals you can get in these situations. The CEO himself, Xpeng, actually increased his personal shareholding not too long ago. In a sector this competitive, this cash hungry, when the founder and CEO dips into his own pocket to buy more stock, well, that sends a pretty unambiguous message. He believes the internal numbers, the improvements they're making, are real and sustainable, despite the fact they're not profitable yet.
That's a perfect segue. Let's shift gears from that momentum story, which is compelling, to the financial bedrock. Volume is great, necessary even, but profitability, that's the ultimate proof of a sustainable business, right? So what do the underlying numbers tell us about revenue growth and, crucially, that path to actually making money?
Right. Looking at the fundamentals, the growth is definitely there. If we look at the trailing 12 months, the TTM, which gives a better picture than just one quarter, TTM revenue ending June 30th, 2025 was $8.42 billion. So yeah, that shows real expansion.
And the analysts tracking the company, they expect that to continue.
They do, generally. The consensus is for continued revenue acceleration. What's driving that is largely their newer models, things like the MONA M03, the popular G9 SUV. These cars are hitting segments where demand is high, and they seem to be priced effectively for volume.
Okay, now let's talk about margins. You mentioned that improved efficiency is key. Vehicle margin hit 14.3% in Q2. Given the, pretty intense price war happening in the Chinese EV market right now. How is Xpeng managing to hold, let alone improve, its margins? That seems counterintuitive.
That 14.3% figure, that's kind of the unsung hero in their recent story, I think.
Okay.
It shows they're executing a classic scaling playbook. First, like we said, volume absorbs overhead, brings down the average cost per vehicle. Second, they've apparently done a good job streamlining the parts list, the bill of materials on the newer platforms like the G6 and G9. That usually means better deals with suppliers, more efficient manufacturing. So yeah, improving your margin health while everyone else is slashing prices, that's a big operational win.
But despite those wins, we do have to address the elephant in the room. They're still losing money, right? Burning cash.
Absolutely. And let's be clear, this is the central risk factor investors need to grapple with today. Even with scaling and better margins, Xpeng reported a trailing 12-month net loss of just under $600 million, negative $597.4 million to be precise. Now, the market seems willing to tolerate this loss for now, mainly because it's seen as driven by investment, not by weak demand.
Investment in what? Exactly. Where is that nearly $600 million going? What's the R&D spend buying them?
It's buying their competitive advantage, their moat, if you will. That cash is fueling a huge ongoing push into autonomous driving software and next-gen battery tech. Crucially, they're focused on building their own in-house software stack. That gives them a potential long-term edge over rivals who might rely more on off-the-shelf solutions from third parties. If they cut that spending drastically, they risk falling behind technologically. But, you have to balance that burn rate against their financial position right now. The balance sheet looks reasonably solid in terms of liquidity. Debt levels seem manageable. This gives them an operating runway, basically, enough time, enough cash to keep going at this rate while they launch the next wave of cars and hopefully finally hit that profitability turning point.
Everyone in the EV space throws around terms like best-in-class tech. But in a market as crowded as China's, with NIO, Li Auto, even players backed by giants like Huawei, what specific advantage, beyond just saying tech moat, does Xpeng really have? What makes them stand out?
It really boils down to their software execution in one particular area: autonomous driving in cities. Their system, XNGP Navigation Guided Pilot, is where they seem to have a lead. Look, most competitors have decent highway-assisted driving systems now. That's become almost table stakes. Where Xpeng is considered top tier, at least among the Chinese EV players, is that XNGP is designed to handle the much messier, complex reality of city driving. Think intersections, pedestrians popping out, unexpected construction zones potentially, without the driver needing to intervene constantly.
So their edge is really that push towards true hands-free city navigation, while maybe others are still more focused on highways.
That seems to be the core of it, yes. And crucially, they own the software stack that delivers it. This positions them arguably more like a tech company that built cars rather than just a traditional car maker licensing software. And their new product pipeline, the M&A M03, the G6, it's all designed to integrate this advanced software into more affordable, high-volume cars. That drives adoption, and just as importantly, collects vast amounts of real-world driving data to improve the system further.
Okay, let's sort of unpack that and look ahead. Investors, they always want to know about catalysts, right? What's coming up? What specific events in the next, say, 3 to 6 months should people be watching that could really move the needle on Xpeng's stock?
Yeah, the near-term calendar is definitely packed with potentially significant events. First up, and probably most important, is the Q3 2025 earnings release. That's slated for November 18th. We already know the delivery numbers were great, but the market will be laser-focused on two things. One, did that 14.3% vehicle margin hold up or even improve? And two, what's their forward guidance for Q4 and beyond? Any sign of weakening cost control or a surprisingly conservative outlook could hit the stock hard. Then there are more structural market things. You've got the institutional holdings disclosure on October 10th. That'll show us which big funds bought in or maybe sold off during Q3. And then a bit further out, the FTSE and MSCI ETF rebalancing on December 15th.
Can you explain that rebalancing a bit more? People hear terms like FTSE and MSCI rebalancing, but why does that actually matter for a stock like Xpeng?
It matters because it can create forced buying or selling pressure. FTSE and MSCI run these huge global stock indices. Trillions of dollars in exchange-traded funds, or ETFs, and passive mutual funds are designed to simply track these indices. So when FTSE or MSCI decides to increase the weighting of a stock like Xpeng in their index, maybe because its market cap has grown or meets certain criteria, all those tracker funds have to buy more shares to match the new index composition. It's mechanical demand, and it can definitely boost a stock's price in the short term and reinforce positive sentiment.
Got it. So those are the sort of known dates, the scheduled events. What about the buzz, the speculation? What rumors or potential news are driving excitement or maybe anxiety?
Well, the biggest speculative story, and it ties right back to that R&D spend and the path to profitability, revolves around the Volkswagen collaboration. Remember, they announced an initial deal for VW to use Xpeng's platform for 2 China-only EV models. But the persistent rumor mill suggests this partnership could get much bigger. We're talking potential expansion beyond just China, maybe even joint development for global markets, or VW licensing Xpeng's tech more broadly.
Okay, how would that change the game? A deeper VW partnership.
Fundamentally, if a global powerhouse like Volkswagen starts building cars for markets outside China using Xpeng's core EV architecture or software, Xpeng instantly transforms from being primarily a Chinese EV maker into potentially a global automotive technology licensor. That completely reframes the valuation discussion. Also high on the speculation list is autonomous driving licensing. There's anticipation, based on some sources, that Xpeng might be close to getting new regulatory green lights, specifically approvals for wider, higher-level autonomous driving trials in more major Chinese cities. This would accelerate their lead in gathering that crucial real-world city driving data we talked about.
And what about looking beyond China's borders? Any whispers on international expansion?
Yeah, there are unconfirmed reports floating around about potential pilot launches. Models like the new M1A sedan or maybe the P7 Plus could potentially appear in select Southeast Asian or even European markets sometime before mid-2026. Look, going international is absolutely necessary for their long-term story. It diversifies revenue, reduces reliance purely on China, and it proves their tech has global appeal. But it's also a massive execution risk. Huge challenges there. But the potential reward, exponential growth.
Let's try and ground all this in the technicals for a moment. Where's the stock actually trading now, and what are the key chart levels investors should be watching?
Sure. So as of October 6th, 2025, Xpeng was trading around $23.07. And the technical picture, it's been decidedly bullish recently. The stock is up, over 125% from its 52-week lows. It's been building a really constructive pattern. Momentum is clearly positive. In terms of levels, key support seems to be right around that recent breakout area, say $20 to $21. That's kind of the psychological zone where a lot of that institutional money likely came in after the strong Q3 numbers. Resistance looks to be higher up, maybe in the $25 to $27 range. A solid break above $27 could open the door to retesting older highs. And importantly, all the major moving averages, the 50-day, 100-day, 200-day, they're all sloping upwards, confirming that sustained positive trend. We're even seeing some analyst price targets creeping up towards $41.80 at the high end for the next few months.
Okay, that technical picture sounds pretty strong, but let's balance that with risk management. Always important. What are the top, say, 3 critical risks that could potentially derail this positive momentum and maybe cause a sharp pullback?
Number one has to be the financial viability risk. Plain and simple. That ongoing net loss, even if it's for good reasons like R&D, puts constant pressure on them. They absolutely must reach sufficient scale and show a clear, believable path to actual net profitability, probably within the next 18 to 24 months. Otherwise, market patience will wear thin. That cash burn is still significant. Second risk, execution risk, specifically tied to that global expansion we mentioned. Trying to enter complex markets like Europe or Southeast Asia is incredibly tough. You've got different regulations everywhere. You need to build service networks from scratch. You're fighting established giants on their home turf. Those initial international steps stumble, it would really damage confidence in the long-term growth narrative. And finally, you can't ignore policy risk. Xpeng's success, like all Chinese EV companies, is intertwined with government policy in China. Any unexpected changes to subsidies, shifts in regulations around autonomous driving permits, or even rules about data security, any of that could immediately hit their costs or chip away at their competitive advantages.
So pulling it all together, we've got record sales, improving efficiency and margins, some big potential catalysts on the horizon, clear tech leadership in autonomous driving. But that's counterbalanced by the ongoing cash burn, the risks of expanding overseas, and reliance on Chinese policy. What's the final takeaway? The investment thesis here.
Based on synthesizing all these sources, the overall rating leans bullish. I'd put it at maybe an 8 out of 10 right now. And the investment thesis really seems to split into 2 potential paths for you, the listener. On one hand, it looks attractive for shorter-term trading, playing those upcoming catalysts like the earnings report in November or the index rebalancing. But on the other hand, it also shapes up as a potentially compelling longer-term investment if you believe in the big picture tailwinds for electric vehicles and you believe Xpeng's tech lead, particularly in software and autonomy, is durable and valuable.
Right. So it comes down to your time frame and conviction, doesn't it? Playing the near-term news flow versus backing the long-term tech story.
Exactly. And maybe here's a final thought to chew on, something a bit provocative. If those rumors about deeper talks with established Western automakers, like VW, actually lead to a major strategic alliance, or maybe a significant platform licensing deal, how does that fundamentally alter how the world values Xpeng? Does the global auto industry start seeing them less as just another Chinese car manufacturer and more as a core technology provider, a licensor? Because that kind of company usually commands a much, much higher valuation multiple in the long run. Something to think about.
That's a really interesting angle, manufacturer versus tech licensor. Definitely food for thought on how this company might evolve. Thanks so much for walking us through all that complexity and providing that crucial context today.
My pleasure. Always interesting to track.
We'll be back again soon with another look at the market's most compelling stories.